They call it the perfect investment. I mean, you've heard it, right? Tax-free growth, market returns, and life insurance, all bundled up in one neat package. But what if most of what you've heard about indexed universal life is, well, only half the story? Today, we're breaking down the unvarnished truth about IULs, how they work, what agents often don't tell you, and what smarter investors are doing instead. Welcome to Invest Education Hub, where we turn financial complexity into clarity, one smart decision at a time. And hey, stick with me until the end. This might just change the way you see safe investing forever.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's dive right in. The promises surrounding IULs are absolutely everywhere, especially if you're on social media. They're often pitched to younger people with this incredible idea that you can use your life insurance while you're still alive to get rich. It sounds brilliant, doesn't it? But is it truly the perfect investment, or is it a very complicated and potentially very expensive trap? That's the question we're going to answer today. We're going to deconstruct one of the most heavily marketed and honestly most misunderstood financial products out there. We've got a fair bit to get through, but here's our roadmap. We'll start with that shiny sales pitch, the stuff that sounds so good. Then we're going to peel back the layers and see how these policies really work. After that, we'll get into the hidden truths, the things agents might kind of gloss over before laying out a simple, powerful alternative. Let's get to it. All right. First things first, let's acknowledge the powerful promises you've probably seen online or maybe even heard directly from an agent. It's really important to understand why this product sounds so appealing right off the bat.
The pitch, you have to admit, is incredibly compelling. First, tax-free growth on your money. I mean, who doesn't love the sound of that? That's a huge benefit. Then you get returns linked to a big market index, like the S&P 500. So you feel like you're right there in the game, participating in the market's growth. And then, the killer feature, no downside risk. The market can crash and burn, and you won't lose a single penny of your principal. All of this is then wrapped up inside a life insurance policy that protects your family. On paper, it sounds absolutely 100% unbeatable. It sounds like the perfect financial vehicle. But how does it all actually work? You know the old saying, if it sounds too good to be true, well, let's look under the hood, because the reality is so much more complex than that simple pitch. And this is where the details really start to matter.
So at its core, an IUL is a hybrid product. It's part life insurance and part an investment-like savings account. But here's the first really critical distinction. You are not actually investing in the stock market, not directly. The insurance company uses all these complex financial instruments, things like options, to just mirror the market's performance. You don't own any stocks. You don't get any dividends from those companies. You're just getting a credit based on how the index performs. That's a huge difference.
So let's follow the money. Every single dollar you pay in premiums gets split. A pretty significant portion is immediately skimmed right off the top. That part pays for the actual cost of the life insurance, plus a whole list of administrative fees, policy charges, you name it. Only what's left over, the remainder, actually goes into your cash value account. You know, the part that's supposed to grow and make you money. This is a fundamental difference from just investing directly, where pretty much your entire dollar goes to work for you from day one.
This right here,
This slide shows exactly how they deliver on that no-risk promise. It's through something called a floor, and it's usually set at 0%. So if the S&P 500 has a terrible year and loses 20%, your cash value gets a 0% return for that period. You don't lose your principal. Sounds great, right? But here's the price you pay for that safety net, the cap rate. If the market has a fantastic year and soars by, say, 25%, your account might be capped at 8%. You get the protection from the really bad lows by completely sacrificing the really good highs. And over the long term, believe me, that is a very, very steep price to pay. And now we get to the heart of it. This is the stuff that's often left out of those glossy brochures and the high-energy sales meetings. These are the critical details that can turn that perfect investment into a really inefficient and costly mistake down the road.
You see those attractive promises of an IUL. They're really just the tip of the iceberg. What's lurking below the surface are all these hidden downsides that can completely sink your financial goals. We are talking about high fees, costs that go up every year, and a really shocking reality about how that death benefit actually works. Let's dig into each of these.
Okay, this is a huge one. As the financial expert Dave Ramsey often explains, the insurance component inside your IUL policy is basically what's called an annual renewable term policy, or ART. What this means is that the cost for your life insurance coverage isn't fixed. It goes up every single year because statistically, you're 1 year older and 1 year closer to, well, In the early years when you're young, it's super cheap. But as you get into your 50s, your 60s, your 70s, that rising cost starts to eat a larger and larger portion of your premium payment, leaving less and less money to go into your cash value. Eventually, those insurance costs can get so high that they actually start draining the savings you've already built just to keep the policy from collapsing. The policy literally begins to eat itself from the inside out.
All right, brace yourself for this one, because this shocks most people who buy these policies. You spend decades paying extra to build up, let's say, $100,000 in cash value inside a $500,000 policy. You naturally assume your family is going to get $600,000 when you pass away, right? The death benefit plus your savings. That is not how it works. In the most common type of policy, your family gets the $500,000 death benefit, and the insurance company keeps your $100,000 in cash value. They effectively used your own savings to pay off a chunk of their obligation to your family. You've been pre-funding your own death benefit this whole time. It's like having a savings account where the bank gets to keep your money when you die. It just makes no sense at all.
And this quote just brilliantly illustrates the whole business model. These are incredibly complex products designed to be highly profitable for the company selling them. Think about it. When you drive through any major city, what are the tallest, most impressive buildings you see? They almost always have the names of banks and life insurance companies on them. They didn't build those empires by giving their customers the absolute best deals. They built them on the fees and the profits they make from products just like this.
So, what does this all add up to? When you finally factor in all the high internal costs, the capped growth, the lack of any dividends, the long-term returns of an IUL just pale in comparison to a simple direct investment. Historically, a well-run IUL might average somewhere between 4 to 6% per year. But a simple, low-cost S&P 500 index fund has historically returned closer to 9 to 11%. Now, that difference of a few percentage points might not sound like a lot, but over 20 or 30 years,
Thanks to the magic of compound interest, that's the difference between having a comfortable retirement and having truly life-changing wealth. So, here is the crucial point. If the IUL is so inefficient for the vast majority of people, what's the alternative? What should you be doing instead? Well, the great news is that the smarter path is also remarkably simpler and way more transparent. Let's just look at the numbers, because this slide makes it crystal clear. Let's say you've got $500 a month to work with. Path number 1, the IUL. That whole $500 premium goes in. After 5 years, you might have about $10,000 in cash value. Okay, now path number 2, the alternative. You buy an inexpensive term life insurance policy for the exact same $300,000 of coverage. For a healthy person, this might only cost you about $30 a month. You then take the rest, the other $470, and invest it every single month into a simple S&P 500 index fund. After those same 5 years, at an average market return, you'd have somewhere between $35,000 and $40,000. That is 3 to 4 times more wealth. And the best part? If you pass away, your family gets the full $300,000 from the insurance, plus the full $40,000 from your investments. It is a dramatically better outcome in every single way. It's not even close.
And this right here perfectly illustrates the core strategy. Keep your insurance and your investments separate. Let your insurance do what it's best at, providing a massive amount of protection for your family for a very low cost. And let your investments do what they're best at, growing your money with total transparency, low fees, and the full uncapped power of the market's compounding returns. You stay in complete control of both.
Okay, but this begs a really obvious question, right? If the math is so clearly stacked against IULs for most people, why are they promoted so aggressively? Why are they all over your social media feeds? Well, let's follow the money.
The answer almost always comes right down to compensation. The upfront commissions for selling these really complex, high-premium permanent life insurance policies can be absolutely enormous. An agent might make 50%, 80%, sometimes even over 100% of your entire first year's premium as their commission. This creates an incredibly powerful financial incentive to sell the product, whether or not it's actually the best solution for the client.
Now look, to be completely fair, IULs are not always a bad product for everyone. They can be a legitimate strategic tool for a very small sliver of the population. We're talking about very high-income earners who have already maxed out every other tax-advantaged retirement account there is, like their 401k and their Roth IRA. For them, it can be a tool for estate planning. But for the other 95% of us, the simpler path of just buying term insurance and investing the difference is almost always the smarter, more effective, and more profitable choice. So after looking at the sales pitch, the mechanics, the hidden truths, and the much better alternative, let's just distill all of this down to one simple, powerful guiding principle that you can use for pretty much all of your financial decisions.
It really is this simple. Your goal for insurance should be pure protection. Period. Your goal for investing should be pure growth. When you try to combine them into one complicated, expensive product, you often end up with the worst of both worlds. You get really expensive insurance and a pretty lousy investment. Building wealth isn't about finding some secret magic product. It's about clarity, it's about consistency, and it's about understanding exactly what your money is doing for you.
And this is the final thought I really want to leave you with. This is the most important question you can ask yourself before you sign any financial paperwork. Is this product serving me, or is it serving the person who's selling it to me? When you look at the fees, the commissions, and the most likely long-term outcome, who is the real primary beneficiary? If the answer isn't clearly and obviously you, it's time to walk away and find a simpler solution. Financial freedom doesn't come from complicated products, it comes from understanding. Indexed universal life isn't always a scam, but it's rarely the best path. Buy what protects you, invest in what grows you, and always understand before you commit. If this explainer helped you see the truth behind IULs, do me a favor, like it, subscribe, and maybe share it with someone who's been pitched the perfect investment. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.